let's talk about bank deposit products. Just like bank debt products, these have a variety of maturities and a variety of interest rate types that can be paid. So let's cover the different types of bank deposits. Similar to bank debt products, deposit products are fairly the same across banks. There's really nothing new being introduced nowadays, despite what's in the marketing, and they have been standardized for all time. Unless they are checking accounts, they usually have a specific maturity and a specific interest rate, such as, for example, savings accounts. They work literally like a loan, but in reverse. The bank owes to the person that's depositing. Deposit products themselves usually include three major types. The first are current accounts, also known as checking accounts or MTAs, money transfer accounts. This is the major type of account that everyone has with their bank, where you can put money in or take it out at any time. It's a kind of operational account, if you will. It's important to note that these accounts can be interest-bearing or not. In most cases, they aren't, but it all depends on the bank, the market, and of course, the bargaining power that the consumers have. These are usually considered what are called stable accounts. That is, although the person can take out all their money at once if they want to, they tend not to, especially if the person is putting in their salary or a fixed deposit every month. Why is this relevant? Because it's the only way that the bank can lend based on these amounts. For example, if I estimate that you have $10,000 in your account and you can take them out at any point, I can't loan $10,000 in loans because there's a severe risk that you're going to withdraw all of it and I'm going to be left holding the bag. But if I consider that the account is stable, you may have a 10,000 account, but maybe you keep it between 8,000 and 9,000, or maybe you even dip to 7, and you only go below 7, maybe once a year, then I can lend 7,000 with a 1-year maturity because I know that statistically you're not going to take it out. They are also the cheapest source of retail funding. So out of all types of funding, retail funding is the cheapest one. And within retail funding, current accounts are the cheapest type. Because in many cases, you don't pay interest. Let's go back to that example. If you have $7,000 that you don't withdraw in your account, and I don't pay you interest on it, whatever the interest rate that I use to lend 7,000, it's all pure profit in terms of interest for the bank. Then we have what are called savings or time deposits. Same principle. As the name says, the capital can only be withdrawn on the maturity of the product. So it can be a savings account from 1 year to 5 years, 10 years, or more. Or it may not necessarily be a savings account, it may just be a time deposit. Same principle. And actually, the interest rate is usually proportional to the maturity. The longer term that the person is willing to have their money locked in, the higher that the bank is willing to pay in interest, because it's guaranteed funding for that amount of time. If you hold savings for 10 years, they can make a 3-year loan, the borrower pays it back, another 3-year loan, the borrower pays it back, and another 4-year loan, and your deposit has never been moved. It's important to note here that there may be the possibility of withdrawing the money beforehand, but that has severe consequences. So the person may lose all of the interest accrued so far, or they may just pay a very hefty fee, which at the end of the day usually comes down to the same thing. In short, since the bank is losing stability and having a higher gap between deposits and loans, they force the consumer to pay for that risk. And finally, we have structured deposits. These can be considered a hybrid of a savings account and an investment product. They are accounts where the interest rate increases or decreases based on financial instruments. For example, a structured account that depends on the mortgage market volatility. If the volatility increases, then my interest rate for this deposit increases as well. If the volatility decreases, then the interest rate decreases as well. In short, the interest rate changes based on the movement of a specific security. Your money is not affected, but the interest that you make is. Out of the different deposit products, the simple current account or checking account is the most frequent, as well as the least expensive source of funding for the banks, as most individuals and small businesses have them. If you have a checking account, you may have a savings account or another one. But if you have a savings account, then you probably also need to have a checking account at that bank. So, as mentioned, while not all clients may have a savings or timed account or a structured account or other products, they will almost always have a checking account to make payments, use cards, be able to store money, and so on. In terms of being a threat to the funding to lending gap, they aren't actually a big problem, as we stated. This is counterintuitive because although technically a person can draw down all of their capital from a checking account at once, they usually don't. If you have $5,000 in an account or $50,000, it's going to be very rare the day where a person says, I need to take it all out and goodbye. So there is usually a predictable amount that is taken over time. So this makes these accounts collectively predictable, and they allow the bank to loan accordingly. In specific, the fact that for big events in life, such as vacations, weddings, and so on, there are usually savings accounts promoted by those purposes also contributes to this. There is a reason for these products. The bank is taking all the volatile money that will be withdrawn and making people put it in savings accounts, forcing them to predict exactly when they'll take out the money. And the checking account will not have that volatility. So that's the reason for those products. And another factor that makes current accounts stable. It's important to note that with the advent of technology and mobile preferences, there are a lot of digital banks nowadays. And many of these digital banks do not have checking accounts. So they flip the paradigm. They only make available investment products, savings deposits, and so on. And these force a customer to have a checking account in another bank to use those banks. This is also why many people don't consider digital banks to be quote-unquote real banks, so to speak, because the existence of a checking account as a product is what usually defines an actual bank. What are some examples? The first is having a notice period for redemptions for savings accounts. It's a similar logic to what happens with investors in hedge funds. In this variation, there's not a maturity to a savings account. You can take your money out at any time, but you do need to give the bank a notice, which may be 30 days, 60 days, 90, whatever. This gives them some time to plan ahead and rebalance the deposits and the loans. Then we have regular deposits. In some cases, to promote stability in checking accounts, banks offer products that pay higher interest rates or that actually pay rates because many checking accounts don't have them under certain conditions. For example, if the person makes a monthly deposit of the same amount, known as a salary account or a saver account, because this creates a steady cash flow in terms of the account and it's considered more stable. In that example, again, if you have $10,000, the chances that you'll go below 7 or 8,000 will be much lesser if you're putting in your salary every month. It may even grow over time. Hopefully for the person, it should. And finally, structured deposits. As we mentioned, in structured deposits, the interest rate is usually determined by the investment returns. In short, you're speculating in the capital market. But instead of winning or losing capital, you're winning or losing interest changes. For example, you make a bet on volatility. If you get it right, instead of making $5,000 or $50,000, you get 1% more on your interest rate. And if you lose, instead of losing money, you may lose 1 or 2% on the interest rate. It's almost like you're speculating with the interest returns and not the capital. What are our key takeaways here? The first is that there are 3 main types of deposit products. These are checking accounts, timed accounts, also known as savings accounts, and finally, structured accounts. These all have different interest rates and maturities, both among the 3 categories as products, but even within each category. Then, it all starts with a checking account. The checking account, or current account, or MTA, money transfer account, is the most frequent and the least expensive type of funding for a bank, regardless of the interest that is paid. And finally, structured accounts are a mix, specifically a mix of an investment product and a deposit. They have fluctuating interest rates depending on the fluctuations of the underlying securities. You don't make or lose money, you make or lose interest. So as we see, there are several types of bank deposits, and naturally, the maturity of savings accounts, for example, is related to the interest that is paid. The more time that you're willing to lock up your money, the more interest that you get paid.